All right, there we go. So we'll go ahead and kick this off. Welcome everyone to Trading Coaches Playbook. This is Brandon Wendell with you. And oops, let me get a few things set up. There we go. So welcome back, everyone. Happy Friday, wherever you may be. Uh, welcome, Brenda. Welcome, Kevin. Good afternoon to both of you. Before we get started here, just a quick reminder, we are not broker-dealers or investment advisors. We're going to be looking at the markets today from an educational standpoint, which means I'm not telling you to buy, sell, or hold anything or giving any personalized recommendations about the markets. And we are also not subject to trading restrictions, so we can have positions in a security or initiate them at any time. So before we get started, just need to let you know you're welcome to join us for a lot of these workshops that we do on a regular basis. Every Friday, we do the Trading Coaches Playbook. We also have Power Hour every Monday. So we got you bookended on the weekend or weekdays, basically Monday and Friday. There's a lot of premium online workshops we do. I'm also very busy during the week. I run the E-mini Think Tank, which is Monday, Wednesday, and Thursday, where we do a live market view and I analyze opportunities in the futures markets. And I've expanded it quite a bit too. It's not just futures markets, but I'm also looking at futures options from time to time as well. And just looking at both day trading and swing trading opportunities, meaning short term for income, a little bit longer term for both income and wealth building. And I also, you can see I'm wearing shirts. It's the SPX Cash Flow Secrets. And basically with the SPX Cash Flow Secrets, do a trade every day around 2 p.m. Eastern to basically generate income. And it's a simple options trade, which we'll be talking a little bit about options today. But, if you're interested in any of those programs, you can go ahead and let us know. Easiest way to get in touch, there's alerts, right? Or no, sorry, alerts links right there. You can also email us if you have any questions at support@wealthbuildershq.com. So if you got questions about any of those programs, please let me know. Like I said, the the SPX Cash Flow Secrets primarily focuses on one particular trade that I like to do on a regular basis to generate income every day on the SPX options. And if you're interested in trading futures as well as futures options, then you want to kind of follow me when it comes to the E-mini Think Tank, and you can check things out there. So we're basically going to be talking a little bit about, I guess it's all socials. Yeah, there's some of my classes that I run. As I mentioned, the SPX Cash Flow Secrets. If you're new to futures altogether, there's Futures Bootcamp for you. And E-mini Think Tank is the one that I was just mentioning that we're on a regular basis looking at the markets. So basically, the markets, speaking of, have been a little bit volatile lately. Take a look at, the NASDAQ. Actually, let me go do this comparison chart first. This is some of the stuff that I do when it comes to the analysis of the futures markets and what the heck has been happening. So if we go back, for instance, let's cancel that. There we go. I wanted to bring it back to the beginning of 2025. There we are. And you can see that we're still down for the year, but not down nearly as much as we had been. And if I zero this out, let's see, set bar at 0, there we go. We can see that the one market that's recovered the most is actually the NASDAQ. It is, believe it or not, positive for the year at this point. Just barely, but it's done it. It is at 0.43. The S&P is still down 0.5%. The Dow, let's see where that is, about 1.5%. And then the Russell 2000, which honestly, that is a more telling story as to the U.S. economy. And that is the reason behind that is it's the 2000 small cap stocks. When you're looking at the Dow, you're only looking at 30 stocks. If I take you out to, let's see, we'll go to this website. Sorry, I'm working on a bunch of other things right now. So I'll log out of those for now and come back to them. But if we go out to, let's say, smartmoney.com, there's a lot of different places you can go. I think, nope, that's not it. Maybe it's marketwatch.com. Yeah, that's the one. Marketwatch.com. Anyway, you can use other sites too. It doesn't matter. But right here, if I click and I go to DIA, I'm basically using the ETF that tracks the Dow to get an idea of what the components of the Dow actually are. So right here, it's the DIA, that's the Dow Jones Industrial Average ETF Trust, which basically it mimics the Dow. So if we go to holdings, now you can see what's actually comprised of. The biggest piece is Goldman Sachs, which is about 8%. Well, Goldman Sachs doesn't really represent the U.S. economy. United Healthcare, 7.66%. Microsoft, again, not really representing the economy because 25% is financials, which is pretty close. I mean, when you take a look at, let's see, CIA fact book. There we go. The World Fact Book by the CIA. And we take a look at countries. Let's go to the United States. It's kind of cool. It gives you a bit of information about the country, but I'm mostly concerned about economics. So there we go. Economy. And it says the world's largest economy, nominal GDP, blah, blah, blah. We know that. Largest importer, second largest exporter. And basically talks about what's going on with our country. And where is it here? GDP composition. So what do we do in the US? Well, we are not agricultural by far. We're not industrial by far. We are actually service oriented. So the United States is a service oriented economy. 76%, three quarters, over three quarters of our economy is services. You know, we make, well, actually, we make debt is what we do. So financial services is pretty much it. You can see. So financial should be representative of the United States economy. Technology being that big and industrials, it is not really representative of the US economy. So what about the NASDAQ? Well, remember, the Dow's only 30 stocks, so we can take a look at the NASDAQ instead. And we have the QQQ for that. And again, I go to holdings. And under holdings, now we can see that technology is 55%, more than half. Well, we just saw that the United States is not a tech center as far as the, our output. Yes, Apple's a US company, Microsoft's a US company, but that is not really the big employers here in the United States. Is not what we're producing. Again, consumer goods and consumer services are really, well, consumer services, not goods. It's really more representative of the US. So this definitely doesn't represent the economy. Okay, what about the spiders, the SPY? That's 500 stocks. So we went from 30 stocks to 100 to now 500 stocks. And again, looking at the holdings, it's better, but still technology is a bit overweighted there. It's a third, over a third of the entire index. Instead, if we go to IWM, so now we went, again, 30 stocks in the Dow, 100 stocks in the NASDAQ, 500 stocks in the S&P 500. Now we've got 2,000 stocks in the Russell 2000. Under the holdings, now take a look at what this is made up of. The majority, over a quarter, is actually financials. And that is basically, other than the government, kind of the biggest sector and the biggest, it's under services, and healthcare is there too. So those are the biggest sectors of the US economy. And therefore, this is more representative of what's actually going on inside the US borders. Not to mention, when you take a look at the individual companies that are there, the majority of the companies that are listed in the 2000 are generating the majority of their income within the US borders. They're smaller companies. When you deal with the NASDAQ, the Dow, or the S&P, you've got multinational companies who are gaining income and revenue outside of the United States. So it's not necessarily representative of the US economy, it's representative of the global economy. Meanwhile, this is more representative of here. Now, why did I bring all that up? Well, because going back, you can see that the US is not recovering as well as the rest of the world is right now. Those macroeconomic global companies seem to be doing pretty good. Meanwhile, we're lagging a little bit. The Russell 2000, is still down almost 8%. It has not completely recovered like the other markets have. And of course, volatility is going kind of crazy right now. If we were to change our chart, let me go ahead and minimize this and bring up, I'll go jump over to the NASDAQ for a moment. Actually, you know what? I want to mess with those charts. Let's mess with this. There we go. I'm going to bring up, let's see. Maybe look at that, the VIX. Let's see. Oops. There we go. Just VIX. There it is. And I'll go to a daily, not an hourly. And let's change this a little bit. Style. There we go. You could see that as of 2025, we've had a bit of spikes. A couple of them right here, March, April. I wonder where those are from. A bit of spikes in volatility. This is the U.S. volatility index for the S&P 500. Again, not the Russell, which probably be a little bit better. I just don't. I don't know if there's a VIX for the Russell. It probably is. I know there's one for the other indexes, but it doesn't matter. This overall represents the volatility in the US markets. Now we have quieted down a bit with a few little murmurings going on, but for the most part, we've been experiencing a lot of volatility. And when that volatility hits, what also happens? Well, you saw, especially if you look at the Russell, markets drop, right? Volatility comes up and the markets collapse on that volatility. So we need to be able to protect ourselves from volatility going forward. I mean, if you were to look, let's see, under trade here, if I go to all products, what do we got? There it is. Looking currently, doesn't look too bad. Volatility. I'm looking right here at what's called implied volatility. The implied volatility basically tells us going forward in the next 30 days, how much of a price swing should we expect on that particular index? So again, if I go to IWM, which is a little more representative of the US economy, notice the numbers are higher. Wow, look at that. Let's go back. SPY. And we're in the 16s, 17s, 18s. So basically, you see the plus minus? That means how many points that ETF, which represents the index, that's how much we're expected to see a swing, either up 10 points, down 10 points, if we're looking at this one when there's 17% volatility. But take a look at the Russell when I went there, IWM, and what do you notice? We've jumped dramatically. Now, point wise, it doesn't seem as much because, again, the index is priced a lot lower. We're dealing with $200 versus much higher, but that's a pretty big move percentage wise. And the volatility is much greater. So we are, in effect, looking forward, expecting a lot more volatility in the US economy than we are in the global economy. Not really much of a surprise given the events that have been going on recently, right? So you've got, let's see, QQQ. I mentioned that we can follow the NASDAQ as well. NASDAQ also has a bit of volatility, obviously, with tech. A lot of overseas activity going on, especially with semiconductors and software, with the tariffs, going on and off. If we look at the diamonds, it may not be as volatile. Nope, look at that. Back down to 17, just like the S&P. So looking forward, we are expected to see high volatility, not that, IWM, in the markets. We're expected to continue to see increased volatility over a long period of time until who knows? We don't know. Could be the next elections, could be sooner than that, who knows? But as of right now, we're living in a world with high uncertainty and high volatility in the markets. So we need to be careful. We need to learn how to protect ourselves. And there's several different strategies that you can do to help protect yourself. First, you have to understand what is it that you have that you need to protect? Well, many people have a 401k. And with a 401k, unfortunately, there's only so many things you could do. Again, let me go back over to my charts here. And let me clean up this chart altogether. Not sure what I was drawing on that for. It was a while back. But again, this is the Russell 2000. And as a matter of fact, well, it's the ETF that tracks it. Let me go to my studies here. Remove those for now. Add in, there we go, volatility studies. We got a lot of different volatility studies we can look at. Implied volatility, there we go. This is implied volatility on a daily basis of the ETF that tracks the Russell. Like I said, I could even still, it'll be very similar if I look at the ES. Okay, you see the volatility is still the same. It's still got those little spikes that are going on. Overall, though, it's a little bit less. And that's why I was focusing on the Russell because I'm kind of following the US economy. But in reality, the majority of 401ks and retirement funds, They more or less follow the ES rather than the Russell, although the Russell, again, may be a little more reflective of the US economy. We can go out and take a look at, let's go to a different website here. I'll just go to Yahoo Finance. As a matter of fact, that's where I want to go. Top mutual funds. Why did I go to top mutual funds? Well, because that is what most people have in a 401k. Like I said before, when you enroll in a 401k company provided from your employer, you don't have a huge amount of choices. You are restricted to contribute money into whatever funds the brokerage that your employer contracted with is allowing you. So you're a bit limited. Actually, I'm wondering if I can do a search. Let's see. Let's do a Google search for it, maybe. Most held in US 401ks. So we got the ICI. They get a lot of good information there. So a lot of them are target date funds, and target date funds are based on when you want to retire, and they do some mixes of stocks and bonds in order to try to get you a target for your particular retirement. Some of them are index funds. Index funds are actually really, really good. The reason why is that typically the fees are going to be lower. If you were to take a look again at top mutual funds here, these are the top performers, I believe, in the last, well, it depends. Let's see, top gainers here. Let's try that. First Trust 52-week gain is 16%, obviously doing much better than the broad market. The problem is when you start going into these mutual funds, this one doesn't have data on it, of course. I'll show you what you want to avoid, though, when you're analyzing your retirement funds. Just trying to find something that's, here we go. Can I sort by 52-week change? There we are. And again, I'm not getting the information that I wanted, but this one has a good rate of return, almost 40% for the past year or for the year to date. But you want to check the expense ratio, because if there's fees, obviously, there is, it comes out of your money. It comes out of your returns. The more fees, the more money comes out. Index funds basically are set up to mimic the broad index, and they don't have to change a lot. The other thing you want to watch for is holdings turnover. And Kevin's saying you're so spot on about 401ks. You're only so many funds to select from. You're at their mercy. Absolutely. And that's your employer. You can always, if you're a trader, especially, you can always set up your own corporation to trade under. Now, do it with a professional helping you, but you can create your own 401k inside of your corporation and then create your own 401k that you can contribute to. You pay yourself a salary as an employee of your corporation because you're hiring yourself to trade for your corporation. So the profits you make in trading go to pay you, and you can contribute to your 401k. The nice thing about that 401k is you can choose what funds you want in it. So you can pick the index funds that have low fees and less turnover. Think about it. Every time there's a turnover, what they're doing is they're selling a stock that's inside that fund, replacing it with something else. Well, you've got slippage on the pricing. You might have capital gains taxes if there is profit on that holding, and you've got commissions that have to be paid and possibly fees. So the more turnover you have, the worse it is for your return typically. So you want to avoid that as much as possible. Like I said, I was trying to find one that's actually reporting these fees and whatnot. They're a little sneaky sometimes. Pro Funds Biotech. Let's see what this one's got. Yep, there you go. Look at this. Oh, that's terrible. Expense ratio. Wow. Well, first of all, they're not making money. They're down 14% for the year. Secondly, you're paying them 1.5% to lose you 14%. That's kind of stupid. And they have flipped their portfolio twice, 200% turnover. That means they were so bad at picking what they did, they decided to flip it twice and they screwed it up worse. On average, that's usually what happens. The more you trade, the worse you usually do. Happens to the pros too, apparently. But, the thing is, I wanted to see if there's anything that's really commonly held. Yeah, it's got Charles Schwab, SWPPX, and those are index funds, as I said. Let's see, what else does it have? Does it have anything here? Retirement data. Well, this is a file I can read. Let's see, what does it look like? Retirement assets, 44 trillion in the fourth quarter of last year. I don't know if it says where they are, specifically. You know, IRAs. See, those are a little more flexible. Individual IRAs, and again, you can protect those. Oh, this was listed in the downloads from the ICI.org. So the ICI.org is a investment company institute. It has a lot of data on investments and retirement. ICI.org. That's where I just did a Google search. What are the most commonly held mutual funds? If you're looking for fees on a particular mutual fund that you might hold, all you have to do is look up the symbol on Yahoo Finance. Again, if I go to markets, top mutual funds, these are for the day best returns. But again, I was trying to see, let's see, year to date return. Can I sort? Lets me sort by 52 week. So right here, Metropolitan West. I click on that. It's up 400% for the past. Let's see what that was. Year to date's barely up. Expense ratio is not too bad. That's 0.56. So that's not bad. You're not paying a lot of fees, but there's the problem, 260% in the turnover again. That's a bit of an issue, right? You don't want to see your money being churned because that's going to cut into the profitability. And it's, yeah, it's not good. So anyway, look at this PDF. I'm not sure if it shows the actual funds. Again, these are 401k plans. And look at what most of the money's in, mutual funds, right? This is last quarter, 2024, 5.9 trillion, I'm sorry, billions in mutual funds and then 3.5 in alternative. But I'm not sure if it'll give me a list of most popular mutual funds. What's acceptable? Well, the lower the numbers, the better. If you're comparing funds, there's not a set number that's the best, unfortunately. Yeah, what's the acceptable turnover rate besides none? I would say 50% or less is probably good. And anyway, like I said, ICI, I haven't been there in a while. What? I want to go to ICI.org. There we go. ICI.org. And you can go into research, and right here you got investor research, retirement research. They have all kinds of statistics and stuff. This is a government site which has a lot of information. Investment fact book. So I don't know. You can check that website out as well. But it'll have a lot of information about 401ks and how they work, and understanding retirements. This is something that a lot of people overlook, but there's a lot of good data, just so you know. And that can help you. So, more plan services fees probably explains a lot of those fees. Yep, exactly. And I'm just curious, downloading the fact book. Oh, there we go. This is what I was looking for, mutual funds. This may actually show the holdings in the most popular funds. Of course, it's probably going to be a huge file they're not going to sort through right this moment, but we'll see. Holy cow. Yeah, it's a bunch of worksheets. But if you can't sleep at night and you want to look through it, maybe you do. Anyway. Yeah, I'm not going to click through all that stuff. I was just looking at my other screen. But basically, what I was trying to get to is you want to definitely try to lower your fees, number one, when you're protecting yourself. And the other thing you can do is when you figure out, let's say you have a couple of different funds. I was trying to find some example funds just for the heck of it here. And while I'm at it, I also need to open up another file that I have. I forgot where I put it, of course. I believe it's in my e-mini think tank file, so I'll look there first. And be under, let's see. So this one might not be the most accurate or up to date. No, I have a better one. Basically, what I'm trying to do is I'll share with you. I want to find my beta weighting in my portfolio, and I'll explain that in a moment here as soon as I find form I'm looking for. I think this might be it. Yes, great. And I created this calculator for this purpose. So basically, if you have a 401k, you can put in the symbols for the in the calculator that I have. And again, this is something I provide for my students in the E-mini think tank, as well as um, just in my programs. But basically, what happens is if you want to protect yourself, you got to put in what securities you own. And these were just some, actually, this was not random. This one was some funds that were in one of my students' accounts, and the number of shares, how much they paid for those shares. There's the cost basis. Now, when you're protecting yourself, you want to protect a portfolio. Let's say you own shares of Apple. Okay, what a lot of people will do, let's go to Apple here. If you own Apple and you're worried about the prices of Apple dropping, as they're doing right there, kind of holding a little bit steady right now, but if you're worried about prices dropping more, you can protect yourself. How do you protect an individual stock? Well, a lot of people just go out and they do what's called buying a put, right? You buy a put, and what happens with that put, it's basically an insurance policy. An insurance policy allows you to sell something at a higher value, even though the value may have dropped, right? You buy an insurance policy on your car, and what happens? You crash your car, you sell it to the insurance company for the value it was before you crashed it. Same thing here. I could sell a put at 200, or let's say I'm willing to take a little drawdown. I sell a put at 190. Okay, so if I sell, or sorry, not sell, buy, you're buying insurance. If I buy a 190 put, that basically gives me the right. No, stop that. My mouse is acting really weird today. Edit. There we go. So if I buy that 190 put, I now have the right to sell 100 shares at $190 per share. Oh, shoot. Now they're calling me. Okay. Until that expires. Basically, you're buying an insurance policy, just like you have with a car. You have to pay a premium for that. The problem is it costs money. For instance, if we go to Apple, come on, and I want to insure myself for, say, 6 months, I go out, oh, we got November, let's do December, 200 months. And the 190 put right here is going to cost me, wrong one, $13.45 per share, or $1,300. Well, let me see. Is my calculator still open? No, it's not. 1,300 and what did I say it was? $45, because 1,345 times 100 shares. So $1,345 divided by $190, or technically it's 100 shares, so it's $19,000. That means I'm paying 7% to insure myself. That's a lot of money to spend. So we can reduce the cost and do what's called a collar. Okay, a collar is an option strategy where instead of just buying the put, you also sell a call, a higher strike call. In this case, maybe we sell the, let's see, where have we been basing? Just under 220. And that helps offset the cost of the put. Okay, so that's a collar. You own the stock. It's called an option collar. It's basically own shares and buy a protected put. You insure them and you sell a covered call to pay for the put. Now, you will not pay 100%, but it reduces your cost. And that's pretty smart. So if we go back to the trade here again, and I look to do a collar, I don't know if I can put that in. Let's see, is collar one of these things? Collar, there it is, synthetic combo. Perfect. So let's say I just click on one of these for now. We're going to buy the 190 puts, and the call I'm going to sell is the 200 call, and it reduced the cost down to $555. So we went from 7% cost at 1345 to I'll do 555 divided by 190 to 2.5%. Well, we'll call it 3%. That's pretty good. We dropped it for more than half the cost. It still costs money, but it costs a lot less. That's a collar. So yes, you would sell to open the I'm sorry, it's 220, wasn't it? I did 200. Thank you. I just remembered. So it'd actually be a little bit more expensive. That makes more sense. Sell the call, buy the put. There we go. Now it's right. 220 call, we're selling, buying the put, and that is a debit of 330. So that's actually even better. So $330 divided by 19,000, we got it down to under 2% for the cost. How cool is that? So we reduced the cost of insuring our portfolio by just doing that. Selling the call, buying the put, and we're now insured if the price drops on Apple below 190. Problem is, if we do end up going above 220, our stock could get called away. But since we've been in a bit of a basing, and remember, you do this if you expect prices to drop, not go up. Now, here's the thing. What if we own Apple stock, but also own a bunch of other securities like mutual funds? Okay, what we need to do is create a position that offsets our losses. Now, if you're doing this in your retirement account, you may have to have a self-directed IRA to be able to do this. Okay, because if you just do it in a regular trading account, you'll make the money back that you're losing in your retirement account, but it'll be taxed differently. So you might have to do a little more aggressive to make sure you're making up what you're losing. Right. So basically, you might have, as I said, you might have your 401k, and that's a retirement account. And we're worried about loss in that account. So what we need to do is have an alternative account, another retirement account. Could be an IRA, could be a SEP, could be whatever it is. Okay, another retirement account to make what we're losing in the 401k. Or if you have another IRA, again, you could just put something in this IRA to offset your losses. That's what we're trying to do. We're trying to offset. Okay. And not worried about the market moving right this moment. Doing education right now. So anyway, we're trying to basically protect ourselves by making the money back somewhere else in some other way. So the thing is, what we're trying to do, first of all, we need to figure out how much insurance do we need? What is the true value of our portfolio? And the problem with buying a collar or putting on a collar is if you try to do it on every single one of your securities, it can become very expensive. So instead, what if we use the ETF or the futures contract, even better, to basically mimic and profit the same amount that we're losing in our 401k? We could do that, but we need to know what is the proper weighting. Because basically, you've got your 401k that you're worried about losing. And in that 401k, as I said before, you might have mutual funds, especially, mostly mutual funds. If you have an IRA, you might have some stock you want to insure, basically, right? Oh, I didn't mean to delete that. It's okay. So what we need to do is figure out, okay, what is the weighting of that? And how much insurance do we need? So to ensure, we have a couple choices. As I said before, you can use a collar on the stocks. Can't put You can't put a collar because there aren't options on individual mutual funds, right? So we just can't do that. So you can do a collar on the stocks. Or, and there's a couple different choices here. If you got individual stocks in an IRA and you want to insure them, collar might work. Or you could use puts on the index, ETF, or futures to offset your losses. Now, if we do it on the index, that's fine. They're not too expensive. ETFs might be a little costly, but they're also available as well. If you do futures, I actually prefer those. And here's the reason why. Futures trade with leverage. When it comes to options, they also trade with leverage. For instance, if I go back over to trade and we take a look at, let's say, SPX, the S&P 500 index, these are index options. And let's say we go out again about, we'll just do 6 months, around 180 days. There we are. We're at 200. Well, we'll do 174. That's closest. Okay. And basically going out that far, let's not go to the collar here for a moment. Let's just go single. And let's say we're worried about the market dropping and we're going to insure ourselves. Here we are. So we could go ahead and buy this particular index put. And what do I choose here? 58.25. And you'll see that is going to cost me a margin of $24,070. Okay, again, because you have to multiply whatever number you have there by 100 for the index, just like you would with stocks. So that would ensure a certain amount of the S&P index. Now, what I need to do is see how is my portfolio related to the index. It's not one-to-one. Okay, that's the key thing. Unless you own index funds, if you own S&P 500 index funds, you're one-to-one, you're set. All you have to do is figure out how many shares you have and make sure you insure enough to cover that. Each one of these puts is 100 shares of the SPX. So again, if you have an index fund, you're done. That's easy. Makes it much, much simpler. But if you don't, and the same thing, by the way, with the ETF. Again, if I go back to, this is 58.25, as I was saying. If we were to go to SPY, it'd probably be about 582, I guess, to be compared. SPY. Again, going out in time. And we can go a little closer to 180 days right there. There we go, 582. Now we're looking at 25.55. So in order to buy a put on this one, it's a little bit cheaper. Instead of 24,000 like it was on the index, now it's only $2,500. A lot cheaper. But if you do options on futures, the thing you got to realize about futures is that they are leveraged. You have to put in a small amount of margin to trade something of much higher value. For instance, if I go over to the ES in futures, didn't mean to do that. There we go. Futures ES. This is the S&P 500 futures. To hold one contract is $22,370. Okay. So you could short the futures contract and that would profit as the markets are crashing. And if you weight it out properly to your portfolio, then it's one-to-one. You're making just as much as you're losing in your portfolio. You're protected. The problem is, first of all, this is not 100 shares. Okay. This ES is equal to 500 shares of SPY. So it's weighed differently. Again, there's some calculations you got to know about and do, and that's why I created the calculators. Also, you're not trading $22,000 worth of stock either. That basically, what was that, 22,000? Well, right now, the S&P futures are trading at what price? 58.65. Well, let's say we do 58.25, like I was saying before. You're actually trading $291,000 worth of stock by trading one futures contract for $25,000 or 22, whatever it was. Now, this is where it gets even more interesting because, again, you've got leverage, right? we've got a good amount of leverage. We only have to come up with $20,000. We got 10-to-1 leverage basically because we're trading almost $300,000 worth of stock for that small margin that I just mentioned right here. Where is it here? Yes. 22,370. But if you trade options on futures, now you're getting leverage on leverage. So again, if I bring in ES futures, it'll bring in my options on those futures. And I go back out to 180 days roughly. 5,800 put right there, 237.25. And look at the cost. It's $11,000. So rather than having to come up with, what was it, 22,000, almost $23,000 to trade the future to cover 500 shares of stock, now we can do one put on the future and it costs only $11,000. Now, granted, if you bought the SPY puts, it was only 2,200. But remember, that's only 100 shares, so you still got to do about the same. It's going to cost you about $11,000, the same anyway. So if you do this collar, however, once again, instead of this, I was just doing single. Let's see, option chain. There we go. Collar synthetic. 5,800. We're going to buy the put. Flip these around. We're going to buy the put and sell the call. Again, I was doing 5,800 and we were doing, I forget what it was now, above. Let's just do 6,000. Okay. Now look at what the cost dropped to, 35.25. So instead of 11 grand, what is this going to cost? No, I did something wrong here. Oh, no. A synthetic is creating what they call a synthetic position. It mimics owning the stock. That's what this is showing right here. If you were to buy a call and sell a put at the same strike price, the risk profile is going to be just the same as if you own the stock. So it's what they call synthetic stock position, basically, or in this case, synthetic futures position. So again, I'm going to raise the price of the call that we're selling. Let's say I went 6,200. That might be too high. I don't know. But right there we go. We got a debit now. And look how much that costs. That's a collar, basically. And we can also buy the futures. But in this case, we can protect ourselves. Depending on how you can put on this position, you might have to do it a little differently. But it's just buying the put. The insurance was $31.50. Actually, this one may not work as well unless you're a higher level options trader because you're going naked on a call. But it's only $3,100 now for the margin. That's pretty cool. Or if we know it's only going to go down for a certain amount, we could actually do this again, buy the put to protect ourselves. And let me flip this around. Oh, wait, actually, no, this is the wrong position. We can do a vertical spread now. 5,800. And if we want to insure ourselves down to a certain point, let's say we don't expect it to drop below 5,300. Is that right? Collar is definitely cheaper, but look at this. I got it down to $5,500 for my insurance. That's pretty good. And that insures 500 shares of the SPY. Now, how do we know how much we need to insure? Well, there's this little thing on every security known as beta. So let's say I just picked this Fidelity Advisor. Oh, let's do healthcare. There's a healthcare ETF or mutual fund, excuse me. So let's say you own this mutual fund. Okay, this is the Fidelity Select Healthcare Mutual Fund. It might be in your portfolio. It doesn't matter. Okay, what happens is you bought shares in this. You can see the expense ratio is not bad, 0.63. Okay, the lower the better. Turnover, 40%. Again, not too bad. It's just not giving a good return right now, but that's okay. This is what you want to look at. Beta. What does beta mean? Beta is a measure of how your individual security moves versus the S&P 500. So basically, the S&P 500 has a 1 beta, which means it moves just like the S&P. Well, it would. It's the S&P. Okay. SPY would have a 1 beta because it's designed to move 1 for 1 with the S&P. This has 0.7 beta. It moves slower than the S&P. So if the S&P gained 1%, this mutual fund would only gain 0.7%. If the S&P dropped by 1%, this would only drop by 0.7%. If you lost 2% in the S&P, this would only lose 1.4%. So do you need to insure 1-to-1? No. You need to beta weight your portfolio to see how much S&P you need to insure, or how much S&P you need to buy to insure, either options or the futures or whatever it is may be. So that's where the calculator comes in, where basically I can go in, figure out what my cost basis is for that particular security, how much did I pay for it, right? This got messed up a little bit, I think. And then it sees the securities beta. This one was really volatile, PTCIX. Let me see if it still is. This was an old picture. Look up PTCIX. So it's a long-term credit bond, 140% turnover, 1.51 expense ratio. That's kind of crazy, but the beta has calmed down a little bit. It's still 194% of the S&P. So it's almost twice as volatile. That means for every 100 shares you were to own of this, you would need to insure by buying 200 shares or shorting 200 shares of the S&P or SPY. Okay. Now remember, the futures are worth 500 shares. So you also have to figure that out if you have, not quite one-to-one insurance, or you may be actually a little biased towards the bullish side or bearish side too. But basically, by putting in the beta weighting of that security, how much it is on your portfolio, you get what's called a weighted beta, and figuring out your entire portfolio right here, this calculator, by putting in all the different shares of the securities. So again, if I wanted to add in Apple, or let's say we also own some Tesla, let's say we own some Chevron. Okay. How much? Well, let's say we own, I don't know, 60 shares. Tesla, we ended up owning 140 shares. Chevron, we own 600 shares, whatever. I would just look up, well, first of all, Apple currently trading at what price? 197. Let's say you bought it cheap and the beta is 1.27. Whoops. So let's say you bought it at, I don't know, 133, and the beta is, what did I say, 197? No, it's less than that. My bad. Keep clicking wrong pieces. 127. There you go. It's only 1.52% of the portfolio, and the beta weighting, there you go. It automatically calculates this for me, which is kind of nice. I programmed this. Tesla. Okay, let's see what that is. Again, I'm just making up a sample example. Now, Tesla is a little more volatile, 2.5% more volatile than the broad market. So let's say you bought this for $205. It's 2.43 for the beta, and there's your beta weighting. Chevron. CBX. And let's say you got this for $90, and you can see the beta is only 0.81, so it's less volatile. You got it for $90, 0.81. There you go. Now, what's the beta weighting for the portfolio? 1.197. So what kind of delta do you need to hedge? Okay, so this basically means that we are a little more volatile than the regular market. So if you just did 1-to-1 for the hedging, you would actually lose money because you wouldn't be making as much on your hedge as you're losing in the portfolio. Okay. Now I converted it to delta because that's an easier way of creating hedges, understanding hedges. Basically, if you every share of stock has 1 delta, so negative 120 is equal to owning 120 shares. So you need to balance out by basically shorting. If you wanted to, you could short 120 shares of SPY because that would give you a delta of negative 120. That's how it is. And what would happen is as the markets move, let's say the market crashes, you're going to lose money in this portfolio, but you'd be making the exact same amount or close to it. Hedges need to be adjusted, by the way. Okay, you can't just keep them static. But basically, you can adjust your hedge, and it wouldn't just be one, by the way. This it's the ratio because there's also a number of shares you have to deal with as well. Sorry, I forgot to get into that. It's a little more complicated, but you could actually create a portfolio of short SPY or puts on the SPY or puts on the S&P ES futures. Or you could even do this with the NASDAQ if you wanted to. You could do the NASDAQ futures if it moves better with that. Because again, the NASDAQ has a little more beta and perhaps it costs less. Now, if we go to QQQ, what's the beta of the Qs? 1.13. So the NASDAQ is 13% more volatile than the S&P. Maybe use that. RTY, no, IWM, the Russell 2000, which I kind of started off with. You could even use that. And that beta is not quite as volatile, 1.18. The diamonds. And you could substitute the futures for those ETFs and again, use leverage, or you can use the options on the futures. Even better, leverage on leverage. And yeah, the Dow is less volatile. But that's kind of neat that there's opportunities out there, but you do need to do what's called beta weighting and figure out your proper beta and then how much negative delta do you need to properly hedge. Delta neutrality means that you're basically making as much as you're losing on the other side. You don't gain anything in net. What was SPY? SPY is one. There is no beta for SPY because it's what it's comparing it to. The S&P. Should say, yeah, see, beta is 1 for the SPY. Always. Because beta is a measurement of how that security moves in relationship to the S&P 500. Yeah. So it's kind of interesting. There's a lot of things you can do. And again, I'm got lessons, like I said before, if you were to go into the E-mini think tank program, I'm actually redoing a lot of this education that I recorded. But basically in the E-mini think tank, there is pre-recorded education as well as live sessions. I already mentioned I do live sessions 3 days a week where we actually I analyze and find opportunities in the markets. But there's simple stuff to keep it simple for looking for income. But then there's also more intense things like this, which I try to break down in simple manners. And what I do is I record. Let's see if it's logging in. I got so many things open right now. Come on. I'm not logged in, I guess. Anyway, but what you can do is you can go into the self-paced education and watch videos. There's documentation that goes along with it to support those videos. And it teaches you how to do those things. And that's what I try to do. I've been an educator. I've been in the markets for 30 years. Actually got started in 1996 as a retail broker, I think, and moved on since then to other things, obviously. But what I do is I try to help people same way I was helped from my mentors and just share my information and my ideas to help you not only build your income or wealth, but also protect what you've got. And there it is, getting the E-mini think tank. Finally logged in. Basically, I have these bonus videos that I recorded a while ago. These are the old videos. What I'm doing right now is re-recording all new videos for the lessons. And some of them are with the class. Some of them are just individual videos that I'm creating. Like this one, it's going to be a little more organized, step by step, how to protect a portfolio. And there's documents that go along with it to help you. And that's kind of neat that I'm putting together that program to, again, help people become more knowledgeable about what they can do in the markets, both to create income and wealth, as well as maintain and protect that income and wealth. So if you're interested in learning more about that, like I said, you can join me at the E-mini Think Tank. We put the links up there before. If not, hopefully you gleaned a little bit of information about what's possible when it comes to protecting portfolios and some of the things you might need to do in order to be able to create that protection for yourself. I want to thank everybody for being here. I got to get going. I got some things to take care of for the weekend. And until next time, everyone, trade safe, trade well, and take care. Thank you for being here.